Hello everyone, welcome back to Fundrise Finance. This week we had the inflation numbers for June released, and the numbers were not good. 9.1% inflation, the highest in the last 40 years, is surely not a good one to look at. And we are seeing this impacting in areas such as food and gas prices the most. Though people may have stopped traveling so much or not pumping their vehicles so much, but still, these high gas prices are impacting them because companies are experiencing higher prices to get their goods manufactured and are just passing their costs back to customers. So one way or the other, you're not going to avoid it. The S&P 500 is still down 19% year to date and looks like we only will come out of this slump once the inflation cools. What surprised me is the market behavior to the inflation numbers. Back on June 10th, when the inflation numbers for May 2022 were released, and it was said that the inflation then was 8.6, the market had just reacted downside and we saw a 6% crash. But this week, on July 13th, when the inflation numbers were announced for the month of June, we saw the market actually going up by 1.13% so far. So, though the numbers were much worse by 0.5% more, the market reaction was opposite. So yeah, it sometimes gets weird how the market behaves. And one other common thing we see with investors is they stop investing in bear markets because they see the prices going down almost regularly. But I came across this interesting fact. What we see here is the 50 best days of S&P 500 almost the last 40 plus years. 46% of S&P 500's best days are during a bear market. As weird as it may sound, this is true. And this reminds me of the famous quote from Peter Lynch that says, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. But no matter what happens to the market, whether it's up or down, one thing that we as a dividend investors do is pick our stocks wisely and invest into them. Because I say it again, bear markets are where wealth is made. Bear markets give us opportunities to make more and more wealth, and we should grab them. In this video, I'll discuss 5 such stocks which are at a very good buy point right now. But before we get into that, let's see how our picks for mid-June have done so far. Here we had Morgan Stanley, T. Rowe Price, Lowe's Companies, Medical Properties, and Target. Of these, Morgan Stanley is almost flat, down 0.36%. T. Rowe Price has returned 3.67% in the last month. Lowe's just over 2%, Medical Properties just over 4%, and Target 2.5%. So we can say most of these are trying to come out of the market slump, but are still undervalued. So for that fact, I have few of these even considered as part of my mid-July dividend picks. To know more about these and everything else, stay tuned till end of the video. So without any further delay, let's check our mid-July picks. The first on our list is Target Corporation, ticker symbol TGT, which we also had as part of our mid-June picks. Target year to date has fallen almost 37%. In the last 1 year, it has fallen 42%. But in the last 5 years, it has returned an impressive 173%. Target has a market cap of $67.44 billion and currently yields 2.46% at a forward PE of 16.97. From a dividend standpoint, Target has been growing its dividends for the last 54 years. That makes Target a dividend aristocrat, which means it's part of the S&P 500 and has been raising its dividends at least for the last 25 years. But also a dividend king, which are companies that need not be part of S&P 500 but have been raising their dividends consistently for more than 50 years. This is a remarkable achievement. The 5-year dividend growth rate is 8.45%, and the payout ratio is very low, just over 28%. Tracker Dividends gives Target a very high dividend score of 96 and considers it undervalued by 44.6%, the fair value estimate of $264.74. Morningstar considers Target a 4-star stock with a fair value of $166. But as for my dividend calculations, which considers current and historical dividend yields, I found Target to be undervalued by 21.29% with a fair value of $177.89. The second stock on our list is Lowe's Companies, ticker symbol LOW. Lowe's is a home improvement retailer and is from the consumer discretionary sector. Year to date, Lowe's has fallen 27.5%. In the last 1 year, it has fallen 5.5%. In the last 5 years, though, Lowe's has returned almost 144%. It has a market cap of $116.56 billion and currently yields 1.75% at a forward PE of 13.53. From a dividend standpoint, Lowe's has been raising its dividends for the last 58 years. So just like Target we saw earlier, even Lowe's is a dividend king and also a dividend aristocrat. The 5-year dividend growth rate is an impressive 17.98%. The payout ratio is very low, just 26.08%. In fact, Target has its ex-dividend date coming really soon on July 19th. So if you own Target stock before this date, a dividend amount of $1.05 will be paid per share on August 3rd. Tracker Dividends gives Lowe's a high dividend score of 96 and considers it undervalued by 49.17% with a fair value estimate of $363.94. Morningstar considers Lowe's a 4-star stock with a fair value of $209. But as for my calculations, I found Lowe's to be undervalued by 21.25% with a fair value of $224.31. Third stock on our list is Omnicom Group, ticker symbol OMC. Not many might be aware of this company. Omnicom is from the communication sector that provides advertising, marketing, and corporate communication services. Year to date, Omnicom has fallen just over 12%. It has a market cap of $13.2 billion and currently yields an impressive 4.43% with a forward P of a very low 9.33. From a dividends perspective, Omnicom has been growing its dividends for the last 13 years at a 5-year growth rate of 4.94 and a payout ratio of 43.14%. Tracker Dividends gives Omnicom a dividend score of 73 and considers it undervalued by 5.78% with a fair value estimate of $68.98. Morningstar considers Omnicom a 4-star stock with a fair value of $90. And as per my calculations, I found Omnicom to be undervalued by 26.3% with a fair value of $82.08. The fourth stock on our list is T. Rowe Price, ticker symbol TROW. T. Rowe Price is from the financial sector and is an investment manager. Year-to-date, T. Rowe Price has fallen almost 41%. The last 1 year, almost 44% down. The last 5 years, it has returned over 46%. T. Rowe Price has a market cap of $25.37 billion and currently yields 4.08%. The forward PE of 11.74. T. Rowe Price has been raising its dividends for the last 36 years. That makes it a dividend aristocrat. The 5-year growth rate is an impressive 15.48%. The payout ratio is also good, just under 36%. Tracker Dividends gives T. Rowe Price a dividend score of 68 and considers it undervalued by 48.28% with a fair value estimate of $223.08. Morningstar considers T. Rowe Price a 4-star stock with a fair value of $155. As for my calculations, I found T. Rowe Price to be undervalued by 31.47% with a fair value of $151.69. The fifth and final stock for mid-July is Air Products and Chemicals, ticker symbol APD. Air Products is from the material sector and provides specialty gases and equipment to industries worldwide. Year-to-date, Air Products has fallen almost 24%. In the last 1 year, it has fallen almost 22%. In the last 5 years, Air Products has returned just over 55%. Air Products has a market cap of $50.56 billion and currently yields 2.81% at a forward PE of 21.61. From a dividends perspective, Air Products has been raising its dividends for the last 39 years, which again makes it a dividend aristocrat. So in fact, 4 of our 5 stock picks this time are dividend aristocrats, and 2 of them are dividend kings. It has a 5-year dividend growth rate of 11.51%, and the payout ratio is almost 63%. Tracker Dividends gives Air Products a dividend score of 81 and considers it undervalued by 31.88% with a fair value estimate of $330.59. Morningstar considers Air Products a 4-star stock with a fair value of $317. As for my calculations, I found Air Products to be undervalued by 32.85% with a fair value of $299.17. So these are the 5 stocks which we just discussed. To summarize, Air Products and Chemicals, Lowe's Company, Omnicom Group, Target, and T. Rowe Price. As we had seen, Air Products and Chemicals, Lowe's, Target, and T. Rowe Price are dividend aristocrats, with Lowe's and Target being dividend kings also. So these are amazing companies which have a great track record of consistently paying good dividends. And as you can see from this list, all of these have fallen anywhere between 14 to 40% and above, and currently are providing a very good buying opportunity, which we should not miss. Hope this video has been valuable. And if so, please don't forget to subscribe to my channel and also like this video so that YouTube can suggest this video to many more people out there. So until we meet our next video, let's do as much as possible to be financially healthy. See ya. Bye.